This chapter 1 discusses the most important indicators relating to economic growth and output, including GDP, market surveys, industrial production, consumer spending and consumer confidence, employment, housing and construction, and foreign trade. The trading community, which includes bank trading desks, hedge funds, and other portfolio managers, pays particular attention to economic indicators. Potential debt and equity issuers and their advisors also scrutinize these indicators very closely to determine the optimal timing for the offering. Hedging decisions are similarly affected by economic indicators, especially regarding the specific type of hedging structure and the timing of its implementation. Market professionals are especially eager to anticipate what central bank actions are likely to result from newly released economic indicators. Actions that typically have a direct impact on the prices of many asset classes. The principal policy objective of most central bankers is the facilitation of sustainable economic growth along with price stability. Market professionals react instantly to new information contained in economic indicator releases, particularly what it suggests regarding growth and inflation prospects, and the likely effect on asset prices implied by these, and then they design and rebalance their trading strategies accordingly. In the next sections, we outline the principal economic indicators that relate to economic growth, and we give examples of the most important data releases from the United States, the European Union, and the Eurozone, based on their established importance to financial markets historically. Perhaps the most important economic indicator is the gross domestic product, or GDP, figure, which measures the total value of goods and services produced by people, businesses, governments, and property located in the country. This is a key economic statistic for market professionals, being a fundamental driver of policymakers' decisions. GDP is usually computed both in nominal and real, i.e. inflation-adjusted, terms, and is often adjusted also for seasonal factors such as the effect of Christmas or other holidays on sales. In most countries, quarterly growth of real GDP on a seasonally adjusted basis is the single most important piece of economic information. It helps to assess the economy's position in the economic cycle, recovery, boom, recession, to measure the spare capacity in the economy, also known as the output gap, and to determine the outlook for employment, public accounts, inflation, profits, and ultimately interest rates, bond yields, and exchange rates. The GDP number provides the broadest picture of economic activity. In the United States, for example, the quarterly GDP figure released by the Department of Commerce is broken down into the following categories. 1. Personal consumption expenditures, PCE, which is the largest component of US GDP, in excess of 70% since 2001. 2. Business investment in structures, equipment, and software. 3. Residential investment. 4. Inventory investment, sometimes called stock building. 5. Net exports. And finally 6. Government consumption and investment expenditures at both the federal and the state and local levels. GDP figures may also be analyzed from a demand perspective. Excluding changes in inventories from GDP helps produce a widely followed measure of demand in the US economy called final sales. Particular attention is paid to any unusually large changes in net exports or government stock building of commodity products. GDP growth is the ultimate economic indicator that drives market participants' reactions. The problem with GDP data, however, is the relative publication delay, illustratively 1 month in the US and UK and 2 months in Germany and France. Also, GDP data is subject to continuous revisions in most countries. Therefore, many other data releases derive their importance from their ability to provide an early indication of, or proxy for, GDP growth, such as industrial production and business surveys, or any new data affecting GDP components, such as retail sales, credit growth, etc. Business surveys provide the earliest insights into current and prospective developments in the economy. The principal advantage of survey data is their timeliness, since they are released much earlier than the official data they track, and therefore provide an early indication of short-term expectations about the state of the economy or the sector to which they relate. Market professionals pay particular attention to surveys that ask a sample of firms or agents about perceived changes in levels of production, new orders, stocks, prices, capacity utilization, and so on. A survey index that summarizes the results is released in addition to sub-indices corresponding to each question. We describe next some of the most commonly monitored US and European surveys to illustrate how they are designed and the typical impact of their results on financial market movements. Each month in the US, the Institute for Supply Management, ISM, surveys about 350 manufacturing agents on recent trends in their business. The ISM survey provides an early indicator of the performance of the industrial sector, which is highly cyclical. The ISM collects data on new orders, production, employment, supplier deliveries, inventories, prices paid, import and export orders, and unfilled orders. For each category, the agents are asked whether the activity has risen, fallen, or remained unchanged over the most recent month. The ISM calculates indices for each category, with an index over 50, meaning that the number of respondents with positive feedback exceeded the number of respondents with negative feedback. The ISM combines 5 of these indices: new orders, production, employment, supplier deliveries, and inventories, into a composite index for which a reading above 50 typically implies that the manufacturing sector of the economy expanded during the month, a reading below 50 suggesting industrial contraction, and readings below 42 normally indicating an economy-wide recession. The ISM also conducts a parallel monthly survey of non-manufacturing firms from different sectors in the economy and publishes a composite non-manufacturing index, NMI, defined as an equal weighted average of business activity, new orders, employment, and supplier deliveries indices. The employment index from this survey is usually used to predict changes in non-farm payrolls. Still in the US, other monthly surveys are conducted addressing business activity on a regional basis, such as the Chicago Business Barometer, which covers the manufacturing sector in Illinois, Indiana, and Michigan, and surveys conducted by the 6 Federal Reserve Banks on business activity in their districts: Philadelphia, the Philadelphia Fed Business Outlook Survey; New York, the Empire State Manufacturing Survey; Richmond, Kansas City, Dallas, and Chicago. In Europe, Reuters conducts a monthly survey similar to the US ISM, but based on 2,500 European manufacturing firms to calculate the so-called Manufacturing Purchasing Managers Index, PMI. Companies are asked to quantify changes in the most recent month in new orders, output, employment, stocks of purchased items, and suppliers' delivery times. Answers are standardized so that a reading of 50 indicates no change, a reading below 50 contraction, and above 50 expansion. There are indices for each question, and the PMI is a weighted average of the 5 questions just listed above. The PMI is considered a reliable indicator of current developments in the European industrial sector. The survey also provides an index of purchaser prices, which is a useful leading indicator of producer price inflation. In Germany, the IFO Institute conducts a monthly survey in which over 6,000 firms are asked for their assessment of the German business climate and their short-term plans and expectations, the output being widely viewed as a leading indicator of industrial production. A similar French monthly business survey is conducted by INSEE, covering economic conditions and outlook among industrialists, and summarized into an index of general economic prospects. As mentioned earlier, industrial production is an important component of GDP that receives particular attention from market professionals. IP indices measure the volume of industrial domestic output and have proven highly correlated with overall GDP growth. IP also has an important impact on the business cycle through its sensitivity to investment spending, stock building, and trade. In the United States, the Federal Reserve Board, FRB, releases a monthly IP report that measures domestic output for manufacturing, mining, and utility firms. Seasonally adjusted production indices are calculated for various industries and market groups. The FRB also releases indicators on capacity utilization that measure the percentage of estimated productive capacity. The utilization rate for manufacturing is viewed as a useful indicator of inflationary pressures in the goods sector, especially when utilization rates approach 85% or so. In Germany, a similar monthly report is produced by the Bundesbank. with seasonally adjusted data that includes a breakdown into four major subcategories: mining, manufacturing, energy, and construction. The market focuses on the annual rate of change and the seasonally adjusted month-on-month figure. INSEE gathers similar monthly data related to French IP, broken down among 7 sectors: food processing, consumption goods, car industry, investment goods, semi-finished goods, energy, and construction. We turn to consumer spending and consumer confidence. Consumer spending is by far the largest component of aggregate demand, 70% of US GDP, for example, and is mainly driven by employment growth, wages, inflation, confidence, and personal wealth. In the United States, the Department of Commerce publishes a monthly retail sales report that tracks sales by retail establishments. Markets pay closest attention to seasonally adjusted month-to-month changes. Figures for retail sales are released in the form of an early estimate 2 weeks after month end, followed by revised figures 1 month later, and final data is issued 2 months after the early estimates are published. The Department of Commerce also publishes a monthly personal consumption expenditures report, which measures household spending for all goods and services. This index is the monthly equivalent of the consumer spending component of the quarterly GDP data. Markets focus on month-to-month percentage changes and their implication for quarterly growth rates of real spending and GDP. Federal Reserve officials have identified the core PCE price index, which excludes food and energy, as their preferred measure of underlying consumer inflation, prompting significant attention to it from market professionals. Consumer confidence is another important market mover, as it is viewed as a leading indicator of future consumption and spending, which directly contribute to economic growth. The Conference Board in the United States compiles a monthly survey of about 5,000 households who share their perceptions of national economic conditions, their personal circumstances, including job situation and the job market generally, and their purchasing plans for new homes, durable goods, and vacations. The Conference Board uses this data to calculate a consumer confidence index of present and expected conditions. A similar survey is conducted by the European Commission to track EU and Eurozone consumer confidence through an assessment of respondents' financial situation, the general economic situation, major purchases, unemployment, prices, and savings. Consumer confidence usually reflects the level of unemployment, and changes in confidence may indicate a disposition to change spending patterns. Private consumption is predominantly driven by developments in the labor market and participants' future expectations regarding labor conditions, both directly through their effect on disposable income growth and indirectly through their impact on consumer confidence. The unemployment rate is the principal labor market indicator, tracking the ratio of people out of work and actively seeking work to the total labor force. Employment growth is cyclical and usually lags growth in business activity. In the first stage of a recovery, businesses try to meet rising demand with their existing payroll, usually through an increase in productivity and overtime. While in the first stage of a downturn, businesses typically wait to see how sustained the downturn is before initiating the costly process of firing workers. In the United States, labor market releases are among the most closely watched and influential economic indicators. The Department of Labor publishes a monthly report called the Employment Situation that provides detailed data on labor conditions, including gauges of employment, unemployment, and wage earnings. The significance of the release stems in part from the fact that it is published earlier than other data, and partly due to the high perceived reliability of the report. The underlying data in the report is drawn from two surveys, a household survey and a payroll survey. Key statistics include the unemployment rate. This measures the percentage of the labor force that is unemployed and actively seeking work. The figure is perhaps the most important and timely measure of resource utilization, since labor is the largest cost factor in production, and the unemployment rate is subject to changes only slowly and in modest amounts. Change in non-farm payrolls. This measures the net number of payroll jobs added or lost in the non-agricultural economy between monthly surveys. Market professionals pay the most attention to this figure in particular within the report because of its direct impact on the calculation of personal income earned during the month. Change in manufacturing payrolls. This is a useful predictor of changes in industrial production, which is published later in the month. Non-farm and manufacturing work week. This measures the average number of hours worked per week by employees in non-agricultural and manufacturing businesses, respectively. Figures give a lead on future changes in real GDP and its IP component. Average hourly earnings. This is a useful indicator of wage inflation and expected changes in personal income. Finally, payroll diffusion indices. These provide the percentage of industries reporting an increase in payrolls over a given period and are used in the estimation of shifts in overall employment. The payroll survey is widely regarded as the most reliable source of data on employment because it covers a broader sample of workers than alternative surveys and provides a detailed breakdown of industry conditions, which facilitates a thorough analysis of changes in labor demand across different sectors of the economy. Still in the United States, the Department of Labor publishes a weekly report called Unemployment Insurance Claims that covers both the number of individuals filing claims for jobless insurance benefits, known as initial claims, and the number receiving payments, known as continuing claims. Changes in initial claims, such as a sustained increase in that number, are an obvious signal of labor market weakness, including a rise in unemployment and incipient recession. Similar reports are released in Europe to track changes in the labor market and to give an indication of unemployment levels. For example, the Federal Labor Office in Germany releases a monthly report containing information on the total number of unemployed, as well as the changes versus the previous month's figure, on both a seasonally and non-seasonally adjusted basis. In France, INSEE releases a monthly report tracking the unemployment rate and the number of unemployed, broken down by age, sex, and sector. We turn to the housing sector, which is an important driver of economic growth due to its extensive use of labor directly or indirectly. Demand in the housing market also provides significant stimulation to economic growth. In recent years, financial markets have paid considerable attention to developments in the housing and construction sectors, particularly in the United States. We outline in the next sections the most important releases relating to the U.S. housing sector. The Department of Commerce releases a monthly report about housing starts and building permits, which reveals the total number of private housing units on which construction started during the month and the number of permits issued by permit issuing places during that same period. Both figures cover only residential housing activity. The permits number is considered a leading indicator since the housing sector typically leads the rest of the economy. Because of the nature of home construction, seasonal adjustments are necessary. The second monthly report released by the Department of Commerce covers new single-family home sales occurring during the month, adjusted for seasonal variations. The report also reveals the supply of new single-family homes offered for sale, changes in the inventory to sales ratio affects housing starts, with builders' response to unexpected increases or declines in inventories affecting significantly future construction projects. The National Association of Realtors releases another important monthly report covering sales of existing homes. Figures for the average and median home price and for inventory of unsold homes are also reported for the nation as a whole and for the four major regions: Northeast, Midwest, South, and West. Financial markets focus on the month-to-month percentage change in total sales and on the median price and supply data. Home purchases typically stimulate demand for household durable goods. They also liquefy accumulated capital gains for the sellers, who use those gains to finance spending. Finally, home price data help gauge the extent to which changes in the value of residential real estate affect household net worth. The National Association of Home Builders and Wells Fargo Bank release a monthly index called the Housing Market Index, HMI, drawn from a monthly survey of members that gauges members' feeling about conditions in the housing industry, good, fair, or poor, including current sales, sales expectations for the next 6 months, and buyer traffic. The HMI has become a useful leading indicator of housing activity and of the residential investment component of GDP. The Mortgage Bankers Association conducts a quarterly survey of delinquency and foreclosure rates on residential properties based on more than 41 million loans serviced by a wide range of financial institutions. The results of this survey were followed closely by market professionals during the subprime crisis in particular. We mention finally by name a number of additional releases related to the housing sector that are of importance to market professionals without providing further details in the interest of time. These include the quarterly Office of Federal Housing Enterprise Oversight Home Price Index, the monthly S&P Case-Shiller Home Price Indices, and the quarterly Housing Vacancies and Home Ownership Rates released by the Department of Commerce. We discuss finally the foreign trade component of GDP. This component is key in particular to foreign exchange market professionals who react promptly to data on foreign trade and international capital flows, arguably the main drivers of exchange rate movements given their impact on currency supply and demand. Foreign trade refers to exports and imports of goods and services between countries or geographic areas. The three principal foreign trade statistics are the trade balance, the current account balance, and the capital account related to international capital transfers. We define each of these next. The trade balance equals the difference between exports and imports of goods and services. The current account balance is the sum of the trade balance plus net income, calculated as the difference between receipts of income on direct investments abroad and payments on local assets held by foreign entities. The capital account, finally, reflects the net change in the national ownership of assets and is calculated as the change in foreign ownership of domestic assets minus the change in domestic ownership of foreign assets. The U.S. Department of Commerce releases a monthly report with detailed statistics on the U.S. trade balance. The data covers trade in both goods and services, segregated into a number of categories. The report also includes figures on bilateral trade with most countries and with various regions in the world. Deviations in these trade figures from expectations often prompt significant changes to estimates of GDP growth. The Department of Commerce also releases quarterly data about the current account balance, which includes the trade balance, plus a summary of international capital flows during the period, in addition to data on U.S. assets held abroad and foreign assets held in the U.S. The Treasury International Capital System, TICS, provides monthly data on cross-border portfolio investment flows into and out of the United States. Market professionals in FX markets view this data as a useful indicator of the strength and health of portfolio flows into the US, and surprises often affect the dollar exchange rate. In Europe, Eurostat publishes monthly data related to the EU and Eurozone trade balance, including extra-EU exports and imports, and intra-EU trade, with a breakdown by trading partner and by type of goods. Eurozone current account data are released monthly by the ECB, containing figures for each component of the balance of payments in the Eurozone. In addition, each country continues to publish details for its own national current account, as well as the remaining balance of payments items. This brings us to the end of Chapter 1.